Welcome back to the channel. Today we're diving into a powerful question for income investors. What happens to dividend stocks and ETFs like SCHD when interest rates begin to decline? We're in a market where many investors have shifted to cash, treasuries, and money market funds because yields were so attractive. But as rates eventually move lower, the tide could turn, and dividend-paying companies might finally see a re-rating that boosts their valuations. Dividend stocks don't exist in a vacuum. Investors are constantly comparing yields between equities and fixed income. When the 10-year treasury was pushing 5%, a risk-free bond looked very competitive compared to SCHD yielding around 3.5%. Why take equity risk if you can earn nearly the same yield with less volatility? But here's the flip side. When treasury yields decline, suddenly SCHD's dividend yield doesn't just look stable, it looks attractive by comparison. This dynamic creates what's called relative yield appeal. Investors start shifting capital from bonds and cash back into dividend-paying equities. Now, let's talk about what a re-rating actually means. When yields fall, investors don't just buy dividend stocks for the income. They're also willing to pay a higher multiple for stable cash flows. In other words, dividend-paying companies can see their valuations expand. Think about it. If SCHD's underlying companies maintain the same earnings but demand for dividend yield increases, the price-to-earnings ratios of those companies can move higher. That's the re-rating effect. Historically, utilities, consumer staples, and dividend aristocrats have all benefited from re-rating periods when the Fed cuts rates. SCHD is uniquely positioned here. The ETF isn't just about high yield, it screens for quality. Companies need consistent dividend growth, strong free cash flow, and solid return on equity to make the cut. That means when investors rotate back into dividend payers, SCHD's portfolio of financially strong companies stands to capture that demand. Also, don't forget dividend growth. While the headline yield is important, investors often underestimate how powerful it is when companies raise dividends every single year. In a falling rate world, stable cash flows that grow annually are extremely valuable. So SCHD doesn't just offer current income, it offers inflation-beating dividend growth that can compound over time. When rates decline, investors sitting in money market funds earning 5% today won't be happy earning 2% tomorrow. They'll start reallocating. Where does that money go? Some flows will go into growth stocks and broad market ETFs like the S&P 500, but yield-focused investors, retirees, income seekers, conservative allocators often prefer stability. That means dividend payers. We've seen this movie before. After previous rate-cutting cycles, dividend ETFs experience inflows as investors chase yield that was no longer available in bonds. SCHD could be a prime beneficiary in this next cycle. Of course, it's not all upside. Here are 3 reasons why rate cuts could be bad for dividend yields. First, if the economy weakens too much, dividend-paying companies could face earnings pressure. That might limit their ability to grow payouts. Second, growth stocks often outperform in declining rate environments too, because future cash flows get discounted less aggressively. Investors may prefer growth over yield. And finally, valuations matter. If dividend stocks re-rate too quickly, their forward returns could flatten out. So while the environment looks promising, investors need to be selective and realistic. The key takeaway is this: if rates continue to trend downward, yield-focused investors are going to look for alternatives. Dividend-paying companies, especially those with strong balance sheets and consistent dividend growth, could see significant inflows and valuation expansion. And for long-term investors in SCHD, that sets up a potentially very attractive total return profile. You get the income today, the dividend growth tomorrow, and the possibility of re-rating driven price appreciation over the next cycle. So, will SCHD re-rate as rates decline? The odds are in its favor. Yield-focused investors don't like being left behind, and dividend-paying companies might just be the biggest winners of the next rate cycle. If you found this video helpful, don't forget to hit like, subscribe, and drop a comment. Thanks for watching, and I'll see you in the next one.